Thank you very much, and it's great to be here this afternoon, and I'm very grateful to have the opportunity to address you on behalf of Moody's. I found today really interesting so far, and in part particularly moving. Now, they say sometimes you need to hear things 3 times before you take them in. So you've heard from the SSM, you've heard from the ESM, and now you'll hear from us about broadly the same kind of type of topics. Now, if you could, so my slides are up there, thank you. So hopefully, great. So the difference I can bring is I've got some visual aids. But we believe at Moody's that economic activity will continue to slow globally in 2024 as the full effects of tight monetary policy and bank lending on aggregate demand are gradually realised. Now, growth in the euro area is expected to pick up to about 1.2%, but that's still very sluggish. Inflation is declining and will continue to recede in those economies where reasonably sound macroeconomic management, together with central bank policy credibility, has kept inflation expectations in check. However, there are risks to that outlook from commodity price spikes, tight labour markets, and exceptionally resilient demand in some markets. And clearly, some of the geopolitical issues that other speakers have referred to today add a whole level of uncertainty to the outlook. Now, as economic activity has by and large held up, elevated core inflation does mean that central banks can't yet be certain that they've achieved their mandates yet. Therefore, we expect this kind of somewhat restrictive monetary policy stance to be maintained throughout the next year. ECB monetary policy has been effective through the banking channel. It's driven up both deposits and lending rates alongside leading banks to tighten their lending criteria. And we expect more of this to happen over the outlook horizon. High interest rates are also expected to continue to result in a fall in loan demand. Now, looking locally, the Cypriot economy remains resilient despite the significant external shocks, and Moody's expects GDP growth of 2.8% next year, which, as the President said to us this morning, is going to be significantly higher than the euro area. But Cyprus's small and saturated banking sector, the bank's small loan book, and low fee income component will, however, limit their long-term business and profits growth opportunities in the domestic market. So that's the downside. But on the upside, we're yet to see any material negative impact on asset quality in the EU. Non-performing loans have been declining continuously, and there's yet no evidence of deterioration in sight, with stage 2 loans, which are those that are higher risk but still performing, are still somewhat stable, implying no large tick up in non-performing loans in the near future. And the rise in loan loss reserves built up over recent years will also help to absorb any new loan losses that do arise. Now, here in Cyprus, where residual asset risk does actually remain high given the still elevated NPLs, the higher interest rate environment and still high inflation, initial indications are also of a limited impact on Cypriot banks' asset quality as banks continue to resolve their legacy issues, leading to further improvements in their asset quality metrics in the last few quarters. And as noted earlier, we've had some positive rating actions on the Cypriot banks as well as the Cypriot sovereign over recent months. Elsewhere in Europe, there are pockets of risk in certain corners. Commercial real estate exposure accounts for around 7% of total lending by European banks. But whilst the average NPL ratio is low, CRE exposure is particularly high in some systems, and maybe some you wouldn't necessarily expect. I think kind of our moderator earlier was talking about the Nordic countries being a beacon of strength, but in Sweden, kind of CRE lending is more like 20%, and we're seeing some problems there as the banks may have to step in to fund the kind of refinancing of around 8.5 billion of market finance to those companies over the next few years, and it's not clear the banks will do that. So it's not rosy everywhere. But despite downside risks, as I heard from other speakers, banks are protected by strong capital buffers, which rose post the Basel III reforms that happened after the global financial crisis. And more importantly, this capital is now predominantly comprised of very high quality common equity. And Elizabeth set out earlier, EU banks enjoy ample headroom to both minimum risk-weighted requirements as well as their leverage ratios. And large Cypriot banks are actually certainly no exception to this. And the Bank of Cyprus posted a common equity tier 1 ratio of 16% and a leverage ratio of 7.2%, both well above the minimum and above the euro area average. And Hellenic, an even more respectable ratios of 20% and 10%, or more than 20% and 10% respectively. Now, compared to the US, interest rate risk in EU banks' books is much more limited, and unrealized losses in bank security portfolios are very modest. And this is down to two things. Firstly, lower risk appetite at European banks, but possibly more importantly, the tight regulation and supervisory judgment that have been exercised over recent years, including the possibility here in Europe of applying higher capital requirements or other corrective measures that didn't apply to those US regional banks that got into trouble. European banks have also been largely protected from the impact of the rapid rise in interest rates, and this compares positively to the US, where less stringent rules and oversight contributed to the bank failures and sector strains. It's also true to note that monetary policy is affecting both deposit volume and mix. Again, I think as Elizabeth talked to earlier, we are seeing a shift towards more expensive long-term deposits, and we've also seen the higher rates and withdrawal of liquidity by the central banks, reducing the deposit base of EU banks. So we are seeing some kind of positive pressure on European banks' funding costs. But that said, banks still report very high liquidity ratios and household deposits, and these are largely forms of household deposits which are guaranteed, which contrast significantly to the wealth deposits at Credit Suisse or the large lumpy corporate deposits at the US regionals, which ran at the first sign of trouble. So European banks are significantly more resilient. And improved profitability, which we think is likely to peak next year, will fade away over time. Interest rates on deposits in the euro area are currently benefiting from the pass-through of policy rate hikes, and betas are rising. And in some systems like France, the repricing of fixed-rate mortgages will be slow. So we will see a decline in profitability looking forward. So to conclude, the operating for EU banks is getting more challenging, although inflation is now declining and there's no sign yet of asset quality deterioration. Regulation in the EU, while not removing all risks from the sudden shift in interest rates, did set banks better placed to manage their risks and reduce financial stability contagion, and bank profitability will peak next year. But conservative lending appetites, particularly here in Cyprus, may limit the role that banks have to play in facilitating growth. Thank you.